Welcome to Retirement Rescue Radio, a show specifically designed to help retirees and pre-retirees maximize their financial efficiency so you can live the retirement lifestyle you've always imagined. Your host is Nate Miller, investment advisor representative and author of the CPR Retirement Rescue Roadmap. Nate discusses thoughts and ideas from some of today's most knowledgeable professionals in the field of finance. He offers strategies along the way to help you make better financial decisions so you can maximize your retirement. This is Retirement Rescue Radio.
All right, Retirement Rescue Radio listeners, welcome to another episode. We've got Redneck Retirement Radio going on today. So we've got Josh with us. How you doing, Josh?
I'm doing good. How's everybody enjoying this weather out there?
So yeah, speaking of that, this is crazy. So we're recording this on the 2nd of March right now, and it is supposed to be in the mid 80s today. Yesterday it was like 70 something. And then like 12 days ago is when we had that huge snow, so it's like, and then the day before that, it was in the 60s. So welcome to Kansas, come live here. You can get all 4 seasons in 1 week. It'd be awesome, right? So I guess I'm just ushering in the nice weather with my birthday yesterday. So there we go. I'm 42 now, for those of you that don't know. So we had a birthday. And how do I celebrate my birthday? I schedule like 6 meetings and I work all day trying to help people secure their retirements. And then I eat a big old ribeye steak. That's how I apparently celebrate. But we usually don't do a whole lot of celebrating on the weekdays. It's the weekend, so we might do something this weekend. So that's how we work. During the week, that's time to get work done. Okay.
At least you're able to reward your meetings with a ribeye. Yep.
There you go. And my wife went out and got that. And we actually found a new place in Lawrence. There's a meat, I don't know what you call it, a meat market, a butcher. I don't know. I haven't been there, so I don't know exactly what to call it yet. And a big old, it was just a little over a pound of ribeye. That happens to be my favorite steak. I don't like the fillets nearly as much, even though I know they're a better cut. I prefer the ribeye. Give me a little bit of fat marbling in there, and it's just rare to medium rare. But that's not why we're here today. So we're actually going to go over some more mailbag questions. So we had people that are writing in specific questions. So we'll have Josh ask a few of those today, and I'll answer them. So what do we got first, Josh?
Let's get started. Marlene says, some advisors just give me the feeling that they're selling me something. How do you differentiate between a financial salesman and a financial advisor? Good question.
Great question there. And you know what? I feel like I feel you there, because I feel like some of them are just trying to sell you something. When I used to consult financial advisors, and there's a difference. There's definitely a difference. Some advisors will be able to help you understand the pros and cons of different types of investments so that you can make an informed decision on whether or not they're going to be the right advisor for you. And so they're more of a facilitator of decision making for you rather than just trying to jam you into a specific product, right? And also, if the only time that you ever hear from your quote advisor is when they want you to buy something, then they may be a salesman at that point. But honestly, I used to consult financial advisors all over the country, and you want someone that is going to be licensed to pretty much offer about anything. You want somebody that's independent, first off, is my opinion there, because they have access to just a lot more stuff. And when I say independent, so you don't want somebody that's working for, maybe one of the big wirehouses, because they can only sell what they have to sell. Now, there's a place for these advisors. They're good at what they do for the people they need to do it for, right? But if that's not you, if that doesn't jive with what you want to have happen, you want somebody that has access to more options. You want somebody that's maybe both in the securities industry and the insurance industry, because risk management is a good process to have. It's part of our process. It's one of the reasons that we are insurance licensed, but we're also securities licensed, because what I would normally see is if somebody is they're only securities licensed, well, then what's the answer to every question? It's going to be something in the securities industry, right? But if you have an insurance only guy, what's his answer to everything? It's going to be something in the insurance world, right? And why do you want to go into the securities world and take on all that risk, right? That's the two thought processes that we would normally hear. And if that's the case, if somebody is literally trying to steer you away from an entire industry because they only work in one industry, that might be indicative of someone that just might be a salesperson. And a lot of times what we'll look at is, during somebody's working years, there's so many articles that are out there that talk about how an advisor is worth far more in retirement than they are during the working years, because in the working years, your advisor might just be your investment guy, and that's it, right? He just puts you in some investments, stocks, bonds, mutual funds, hope they go up. Let's just shoot for growth because you're young, you got a long time horizon. But once you get into retirement, there's a lot more pitfalls. There's a lot more risks that you have to mitigate, you have to overcome. And so you might have to have an investment guy. Your investment guy might also need to be your income guy, because now you're moving away from needing growth to now needing income from your investments. And so your advisor needs to be able to develop some type of an income plan. So there's a couple different places they need to plan for, if they can help you with taxes, because taxes in retirement are a lot different. We were told that we're supposed to be in a lower tax bracket when we retire, and I'm seeing a lot of my clients that aren't, and so they need to be able to at least help out with lowering taxes. And if not them, maybe they have access to a CPA or something that can help you do that as well. And then, what about long-term care? There has to be something in place for that, because it's really, really expensive. And there's got to be something, that can eat through a nest egg pretty darn quick. And so we want to be able to transfer some of that risk to a third party. And then legacy planning, when you're gone, what are you leaving for the kids? Is it tax advantage? So there's, that's like 5 different areas that I talked about right there, rather than just being the investment guy. And so that's how you might know whether or not your advisor is, quote, just a salesperson, is, are they developing a complete plan, or are they just pieces here and pieces there? And, they may, if someone develops a complete plan and then maybe calls you with something that fits into that plan, even though it might be a single product, I would still call that person an advisor rather than a salesman. But if there was no complete plan, if it was just, here's your investments, and then, here's another investment, here's another investment, here's another investment, here's another, then that might be a little bit indicative of a salesperson, in my opinion, I would say.
We like to educate our clients on how different products do fit into their complete plan.
Yeah.
So,
and the pros and cons.
We don't just like to say, here's these products that fits into this plan, and here's your result, and, trust us. It's like, no, we want to educate you why we're doing this.
Yep. Not only what you're in, but the why behind it, the thought process. And
Exactly.
Granted, we're not going to give you obviously we can't spend enough time to give you, like, put my brain in your brain, everything that I know, and instill that into you. But we want to help you at least have a working knowledge of why we're putting you in what we're putting you in. There's a chapter 11 of my first book is called The Purpose-Driven Portfolio Allocation. The purpose of your money dictates where it should go. Why should it go there? Well, there's certain goals that we're trying to accomplish that you have, and certain financial tools do each job differently and better than a different financial tool. And so we want you to understand why we're choosing a specific financial tool for a piece of your portfolio or a piece of your plan. So not just saying, this is it, trust us. No. I want you to understand. All right.
Yeah. So that wasn't a short answer to that question.
Yeah, I think I'm rambling now. So we should probably move on to the next one.
All right. Good idea. Tom says, I recently applied for a mortgage, not my first, and I noticed where I had to list my assets, there was a line for cash value life insurance. Has this always been there and I just didn't notice it? And the bigger question, why does the bank say it's an asset?
Great question, Tom. So first off, I don't know if it's always been there. I've bought a few houses and rental properties, and even now the commercial property that our Topeka building is in. But I don't know if that line for cash value has always been there. But the answer to why does the bank say it's an asset? Because it could be. If you have cash value inside of a life insurance product, you can access that. You can either access that through taking withdrawals, but they might be subject to income tax based on any growth that's happened in there. But if you take it out in the form of a policy loan, then there's no income tax that would be paid on those withdrawals. And that could be a way obviously to access stuff. To give you an example of what I've done with the cash value inside my life insurance is I have used that in the form of a policy loan to then use it for a down payment and then remodeling on some rental property. And then once all of that was done, then it increased the value of the rental property. So I did a cash out refi. So what that means is you do a refinance of the property, and the increased equity you can actually pull out sometimes 70% of whatever the value of the property is. They call it, 70% loan to value ratio. And so I can pull that money back out with that increased appreciation. And then I can put that back into my life insurance product, and it works out really well. And so that's one of the reasons banks say it is an asset. And banks actually buy a lot of insurance. And so, that's why it's an asset. They look at life insurance as an asset class, because if you think about it like that, it can be. And even before you die, it can still be an asset for you. A lot of people say life insurance is not really life insurance, it's death insurance, right? It's you don't get any benefit from it because once you die, that's when the money finally gets paid and you never got to see it, right? But no, it can be an asset while you're still living if utilized correctly and if structured properly.
That's right. So long answer short, it's another account that you have access to.
Correct.
All right. So next one, Brian says, I'm thinking about putting a swimming pool, or maybe I should say that my wife and daughter are campaigning very hard for a swimming pool. And I question whether or not it's a wise investment, because I don't think it would actually increase the value of my home by the amount that it would take to install it. But if I do install it, should I just take the home equity loan to pay for it? And I wanted to ask this question for two reasons. And I'm curious on your thoughts on the mechanics of how to pay for big purchases, not just, pool or whatever. But more importantly, I'm curious to see your perspective on how to evaluate what makes a good purchase or investment. Where's the kind of situation where, maybe it doesn't really increase the value of the home or the net worth, but you're really going to enjoy it. So maybe paying for some kind of entertainment, like a boat or camper. How do you really make decisions on big things like that to where there is an entertainment or a family value to it? So 2 questions: home equity loan and large purchase considerations.
Okay. So that might have been
a long answer right here.
Yeah, that might have been one of the longest questions I think we've received so far, Brian. But thanks, because first, the question I would ask before even thinking of putting in a swimming pool, it's like, I know I've been in that situation before, not quite that specific one, but the situation to where you've got your wife and kids that are wanting a certain thing and you're just seeing the dollar signs. You're like, I don't know if I want to do this, but it's going to be fun for the kids and it's going to make memories. And I understand that. That's one of the reasons that we do have a camper. We don't have a pool at this point, but our backyard is not big enough to be able to put one of those in. But that aside from that, here's what I would ask. Before even thinking about making a huge purchase like putting in a pool, are you saving for retirement? Are you saving for retirement? If you're not saving for retirement, heck no, I would say no right off the bat right there. If you are, how much? Are you saving the adequate percentage? Have you sat down with an advisor and figured out how much you should be saving per month or of your salary? The gold standard is about 15% of whatever your salary is. That's what you should be saving on a monthly basis. And so if you're there, if you're at that 15% and you're saving that, then I would say this next caveat would be, will putting in that pool, if you are saving the amount that you're supposed to be saving, will putting in the pool affect that? Will it lower the amount? So if you're now paying off the home equity line of credit or loan or whatever it is that you're getting, or if you take a loan on your 401k or something, and you want to pay it back, it's like whatever it is that you're doing, is that going to affect how much you're saving for retirement? I would not recommend doing the loan against your 401k. The HELOC actually would be a better choice, especially if you are thinking of just straight up withdrawing money from any of your retirement accounts. You're going to have to withdraw more than what it costs because you're going to have to pay taxes on that. And so the home equity line of credit's not necessarily a bad idea to do that, but I would put a caveat in that saying, first off, make sure you got the other ducks in a row. Make sure that you are saving enough for retirement. Make sure that you have either met with an advisor and you've got some kind of plan on how much you're supposed to be saving. And if putting this in and then paying it back off is not going to impact what you're saving for retirement, go right ahead. Go right ahead. we got a camper here in June of 2021. And one of the ways I was able to justify buying it was the fact that when we're not using it, we put it up on RV share. And so other people are renting it out. And so now we've turned this, basically, I would call that a depreciating asset. It's like a car, it's depreciating. It's not going to be worth more in most cases. I know there's been some crazy markets going on here recently with COVID and people buying campers, and some have sold for more than what they bought it for, but that's not the norm. All right. That's not the norm. It's a depreciating asset. And so I've taken a depreciating asset and turned it into somewhat of an income stream to offset some of those costs, because we do realize it's going to be fun. It's going to make memories with the family. And so that has value, but I want to make sure that everything else is set in place first, because I want you to have fun. I just don't want your fun to, shackle you into financial hardship. Right.
Yeah. Especially later in life, and knowing whether or not that affects your retirement. The big purchase is having a comprehensive plan and setting down with your advisor before you make the big purchases, not say, hey, I bought this. What's it going to do to me? No, we don't like hearing that.
Or I did.
Hey, I'm thinking of this.
Yeah.
Can I do it?
Or I did a thing. It probably wasn't the best. Can you fix it? I don't like that. So one, Brian, great job of asking this question before putting in the pool. And two, I would say, I mentioned, financial advisor, if you've got a plan, and you're following that plan, great. If you don't, we'd love to be able to sit down and figure that out for you and help you figure out whether or not you can put in a swimming pool. We'd love to be able to help you figure that out, because I'm not the advisor that says you can't spend your money. Right? You don't just want a huge pile of money that you can swim through like Scrooge McDuck. That's not the purpose of it. The money is supposed to be doing something, enriching your life, creating those memories. And so, if there's a way you can do it, I want you to do it.
Awesome. All right. Next, Reba says, I think my fees are too high with my current advisor versus what I could pay at, say Vanguard. How do I know if I really am paying too much in fees? Good question here.
Yeah. So I would first say that look at a couple different things. Don't just look at the cost, look at the value. And I got a funny story in my childhood of cost versus value. It was really the first time I realized that you get what you pay for. And I went into a dollar store with my mom. And at this time I was in 7th or 8th grade, I think, and playing basketball at this point. And I saw a pair of shoes in this dollar store that looked like Air Jordans. The only thing that they were missing was they just didn't have the little Air Jordan, logo on there, because obviously they were knockoffs, right? But they looked like that year's version of Air Jordans. How did I know that? Because I knew that I would have no chance of ever having Air Jordans as a kid, but I knew what they looked like because I would love to have them, right? I mean, if anybody's been following me for a very long time, you knew that we did not have a whole lot of money growing up. And so I was like, I could look like I have Air Jordans. And, from the bleachers, nobody's going to know they're not Air Jordans, because they wouldn't be able to see that little tiny Air Jordan guy on my shoes anyway. And plus I'm moving so fast that, right.
So then why do you need Air Jordans if nobody can tell?
Well, they could tell just because of the way the shoe looked, but they don't see the little logo. Right. So I'm like, yes, I can get those. And they were like $10. So $10, we can afford a pair of shoes for $10. And so we got those. They lasted one game. And I had holes in the soles of the shoes by then.
Wow.
Yeah. My socks were on the floor of the court by that time. And then we had to buy new shoes. And so, definitely got what we paid for there. And so value is what you get. Cost is what you pay. And what we're looking for is value. So you want value for what you're paying. And once again, are they just your investment guy? Right. Or are they, I guess, Reba, I don't know how close you are to retirement. So maybe that's all you need right now is just an investment guy. But one of the things that we do is we actually analyze people's portfolio. And as part of that portfolio analysis, we do look to find out what kind of internal fees are inside all of your assets. Now, if you have statements that actually break out what your advisor is paying, we can analyze that as well. And then find out if you're getting any kind of value, as we have a conversation with you, is there value? Are they helping you get comprehensive planning, or are they just a broker making trades for you? If they're a broker just making trades for you, then there might be some better things to do. And as far as like just the internal fees and fees for a financial advisor go, like I said, you want to make sure that you're getting value for it. Also, we can find out what type of fees you paid when you initially got into those products, whether there were loads or anything like that up front. And so we can just find out whether or not that their investment style really meshes with what your investment style really is. And we don't necessarily want to look for the cheapest funds. We want to look for the most effective and the ones that will work the most. And maybe they're not even funds, maybe they're portfolios, so there's just a lot that goes into that. And it's all about value. It's all about what you're getting for whatever you're paying. And I guess I would submit that if you're wondering if your fees are too high, then it may be worth looking into, because you may be feeling that you're not getting a whole lot of value right now anyway. And so if that is the case, then maybe you should look to find somewhere else to where you can get something like a portfolio analysis and find out what a breakdown of the actual fees that you're paying are. Right. And we'd be happy to do that if you want to reach out to us or reach out to anybody else that can do that, and tell them the same thing about what you're looking to have done. And then they can do that for you.
Yep. Yeah, definitely make sure you're getting value in all the services for what you are paying. If it's within your goals, and yeah, but if it's not, a second opinion is definitely a good idea.
Yeah. Like I said, there's been plenty of times where we've had people come to us that are working with another advisor, and we go through all the different areas that we cover, because we do investment planning, income planning, tax planning. We help with, long-term care, health planning. We help with, we're also licensed to do Medicare supplements and stuff like that. So we help with that. We help with any legacy planning, life insurance, or anything like that. And so we cover all those different 5 areas. And if somebody comes to us and realizes, wow, my guy is just my investment guy, and you work in all these other areas, well, then they see a lot more value. And sometimes we're even able to lower our fees compared to what they're currently paying, and they're getting more services. So that value, I'm going to stop rambling and just say value.
Yes. Good idea. All right. Marie says, we just found out that in about 6 months, we're going to be grandparents for the first time. And so from a financial planning standpoint, what kind of investments should we consider for him or her after birth that would be helpful? And we have some friends that recommended buying a life insurance policy on the kid because it's really cheap. What's your thoughts?
Okay. Well, thanks for that, Marie. And first off, congratulations. You're going to start having a lot of fun with that little kiddo. And I guess you didn't say whether or not you are in the same town or anything, but if you are, be prepared to be, grandma daycare. So my in-laws are in town, and they babysit a lot. So I don't think we'd be able to do half the things that we do if we didn't have somebody like right in town that that we can take them to. I guess we'd just be paying a lot more for it.
Yeah, that's true.
We pay for it in the form of, hey, here's a gift card to go get a massage or something like that. That's how we end up saying thank you, is here's massage and here's this. And then, we're not necessarily just doling out dollars to them. It's more in the form of thank you services. But anyway, so for you, places to put money. Life insurance would be really, really inexpensive on a kid. So that could work. So here's the thing with life insurance though. Anytime you're buying it, it has to be set up for the purpose that you want to use it for. Because there's a lot of levers inside life insurance that you can pull that can make it set up properly or improperly for whatever you want to have happen. For example, in the case of the kid, if you're just trying to buy a life insurance policy that's going to have the absolute maximum death benefit, but you actually wanted that to be an investment that they could tap into later on down the road, well, that's probably not the right way to set it up, because now any growth inside of that permanent, if you're talking about permanent life insurance, any growth inside of that cash value is going to be eaten up by fees, higher fees, if you just get the maximum death benefit. But if you're able to lower that death benefit to the IRS allowed minimum, then your growth potential can be higher, because now there's not as high a fees inside the policy, and you can take it out in the future as tax-free policy loans, and that they could use for tuition or books or anything like that in the future. So, I mean, it could work. And a lot of places, a lot of colleges will also not count that as an asset that the kid can tap into. So they don't look at like retirement plans like IRAs or 401ks. They don't look at those, but they'll look at non-qualified accounts like brokerage accounts. They'll look at that and add that into assets that could be used by the kid. So, I would say that could be one of the places. Of course, you've also got 529 plans, Learning Quest plans that you can set up as well, but those have to be used for schooling, for education. Cash value from a life insurance policy does not. It can be used for whatever. Right. And so if they decide, you know what, I don't think college is for me, maybe they go to a trade school and they learn a trade, like, gosh, underwater welding, those guys make a lot of money, right? And so maybe that's what they want to do, where they want to start a business, right? So now you're not limited to what you can help them do. So that's another benefit of the cash value standpoint. But once again, I got to stress that it's got to be created correctly. It's got to be, what's the word I'm looking for? Created. It's got to be structured. There we go. That's the word I was looking for again. Structured. The policy's got to be structured correctly.
Yes, that's very important, because a lot of sales advisors don't set them up correctly for what you're really wanting. Mm-hmm. So, all right. So last one here today, I think, is Carlos says, help me out here. I feel like the stock market is due for a correction, or right now a bigger correction. So I'd like to move some money out of stocks, but bonds are pitiful right now. Cash is bad because of inflation. Yeah. I've never been a big believer in gold. Good idea. Where am I supposed to put money right now? At least he didn't say crypto.
Under the mattress, Carlos. No. Kidding.
Bury in the backyard in a jar.
There you go. So I would say, first off, to that, people have been saying the stock market's incorrect for years. And eventually they will be right, because eventually it will happen. I mean, I kind of don't really count the whole little blip in 2020 from the coronavirus. I don't really call that a correction, because it was so short-lived. Most of the time throughout history, when the market goes down as much as it went down during the coronavirus, it takes a long time to come back. It doesn't come back within, just a few months like it did in 2020. And so I feel like, at least by my definition, I feel like we haven't had that big correction that people are talking about. And honestly, we need to start, first off, I want to define some stuff first. A correction has a specific definition. I'm going to say pullback, correction, and bear market. Those are going to be the three definitions here. And a pullback is basically just a pullback of 5% to 9% of the recently hit high in whatever indice we're talking about, S&P, Dow Jones, NASDAQ, whatever, right? So that's 5 to 9, that's a pullback. A correction is 10% to 19%. All right. So that's a correction. And a pullback of 10% actually happens almost every single year, if not like multiple times in 1 year. Yeah. Like 1 to 2 times per year, you'll have a drop of 10% from the old high, and then it might end up coming back. And that's just normal, right? And so I think what people are really concerned about is that bear market, the 20% plus loss from a recent high. That's what people are really concerned about. And like I said, people have been talking about that for years, that we're going to have one, because we were in the longest bull market in history, right? So we are due. So yes, there will be a correction eventually. Is it happening right now? I mean, I don't have the crystal ball, right? Nobody really does. But I would say this: time in the market, not timing the market. And right now, if your stocks are down, pulling them out and trying to putting them somewhere else might actually be a bad idea, right? Because what you just did is you bought high and you're selling low. That's the opposite of how you make money in the stock market. And so I'd say first off, and you didn't say whether or not you're working with a financial advisor right now. So I'd say if you are not working with a financial advisor and you would like to, we'd love to be able to find a little bit more about your situation to like fully be able to advise you here. But stocks historically have been great places to put money, depending on how far out you are from retirement, how old you are. It doesn't say that here. That could still be a great place, because if you've still got a long time horizon, and the market goes down, it doesn't really matter because you're pumping money in. I mean, if you're contributing regularly to a 401k, which again, it doesn't say that right here. But if you're pumping money in right now, you're going to have more money in at these lower prices, these lower share values, and then that's going to go back up. You're going to have more money going back up. And so depending on where you're at in your financial life right here could determine what that answer is. But in bonds, I'm going to talk about this for a second here, because bonds, we're in a unique environment with bonds right now. It used to be when people put bonds inside of a portfolio, the reason they were doing that was because, one, they wanted some stability, and two, they wanted income from the interest that it was generating. And the problem is those two reasons to have bonds in your portfolio aren't really being fulfilled by bonds today. One, because interest rates are so low that the interest that you can get on some of these bonds isn't really a meaningful income stream anymore. And two, they're not as stable as they used to be. I mean, they were down last year. They're still down this year so far. And so the problem with that is, even looking forward, so that's what happened in the past, even looking forward, bonds have an inverse relationship with interest rates, meaning if interest rates rise, which we've already been told that the Fed plans on doing that a few times this year, but as interest rates rise, well, if you're currently holding a bond or a bond fund, right, which that's how most people hold bonds, is within bond funds. So now your bonds are worth less. No, they're not worthless. They're worth less. They're worth less because if interest rates go up, who wants to buy your bonds that are paying less percentage than ones they can go out and buy now? Right? If your bonds are paying 2% interest and they can now buy some that are paying 3%, who wants your bond buying 2%? So the value of your bond just went down. Your bond lost money. And so that's what we see ourselves. That's the environment that we see ourselves in going forward with bonds. So you are right. Bonds are pitiful at this point, in my opinion, too. And if you want some safe places, I mean, we have other alternatives out there. I've done I think a couple podcast episodes ago where we're talking about some safe liquid growth inside of a very specifically designed life insurance product. I feel like we're talking a lot about life insurance today. We've had a lot of life insurance. I guess we've had a lot of life insurance questions. So I guess if you have a lot of life insurance questions, you got to talk about it.
Yeah.
It's a very unique asset class. And so once again, this all depends on where you're at in your retirement or your financial life, what your goals are, what your risk tolerance really is. And so if you're already feeling a little, you got that feeling in the pit of the stomach from what's going on right now, it's like maybe you're not aligned correctly from a risk standpoint, and maybe some things do need to be changed, but it's got to be part of an overall plan. It can't just be, pieces here and pieces there. So I would say if you want to reach out and we can actually find out whether or not you are in a good spot, or if there is some changes that need to be made, but it's going to be based off of an entire process.
Yep, that's true. Yeah, we talked a lot about having an entire plan made as well today. So very important.
And again, time in the market, not trying to time the market. That's key.
Yeah. All right. So that's it today. Nate, if they wanted to ask you a question, where do they go?
Don't know. No, they go to asknate@retirementrescueradio.com. I
just try to find it.
You can go to our website, millerretirementgroup.com. There's all kinds of ways to reach out to us. It's like we'll probably have some of those links in the description as well to our website. If somebody wants to get a hold of us, there should be a link to a 15-minute phone call so you can have access to our calendar. That'll probably be in the description as well. So yeah, a lot of stuff on the show notes.
Cool. Sounds good. Go ahead and enjoy the weather.
Yeah, no kidding. Mid 80s. What the heck? In March. It's nuts. That's summertime. I love it though. It's summertime weather. That's like swimming weather, but there's no swimming pools that are going to be opening because it's 85 degrees in March.
No, not here.
Nope. All righty.
So,
well, cool. Anything else, Josh? Is that it? We're good.
No, I think that's it for now.
Cool. All right, guys.
Until next time.
Yep. Until next time, have a great week. And hopefully that helped answer some questions that some people may have had similar questions. And so you're getting a little perspective on how to think through some things. So that's it. Take care, guys.